couple of things I kind of wanted to circle back to. A, you mentioned not putting all your eggs in one basket. You correct me if I'm wrong, Clifford. I mean, the fact that it's the fund and Equiton is regulated by the Ontario Securities Commission. You can't put someone's eggs, all their eggs in one basket.
I would say, depending on your financial position, how much, debt you have, that kind of thing. Generally speaking, you don't want to have more than 20 or 25% of your net financial assets. So that would be your liquid assets, your cash, your investments, your pensions, that kind of thing. You probably don't want to have more than 20 to 25% of your net financial assets in private investments. So not necessarily us, but just kind of private investments in general. But that would be something that is very specific to a particular investor. So we would go through that kind of qualification to make sure that it is appropriate, because you're right. We have to satisfy the OSC in terms of what is appropriate and what is suitable for an investor. And, you never want to create excessive exposure for an investor, because, life happens. They may need to get access to the money, and private investments aren't instantly, you can't just sell them instantly. You can't call your broker. You can't just hit sell. So it does take time to get that money. So, we need to look at each individual investor's liquidity and to make sure that it's appropriate for them.
You mentioned the word
and we
returns.
have turned down.
Right.
We have turned down investors say this is not appropriate for you.
Well, I love that. Like when we make introductions sometimes to you guys, you'll come back and let the client know that you can't do this investment. For me, for somebody who made the introduction, who had to go out on the limb and make that introduction, to hear back that they couldn't make the investment because it wasn't right for them in their portfolio or they didn't meet the criteria, that actually makes me feel really good. And I can tell you feedback directly from our clients and our REC insiders is the exact same, because someone's watching over. That you're not trying to just, you have 100,000 in RSPs, we can take it all. That's not the conversation that's going to be had. In fact, I do want to touch on that before we let you go in terms of what the actual process is like. But I know everyone who's watching right now is probably sitting at the edge of their seat and saying, we heard Clifford say the word returns. What is the returns? And I know you guys are very, very ultra conservative. I'm not trying to put you on the hot seat, but just your track record, maybe what are you comfortable in terms of talking about? Because I know if you leave it in your bank, you get a very high interest rate in your RSPs. I hope everyone caught that. That was my joke for the day. So it's obviously anybody who's watching this who's thinking about perhaps taking it out of the green bank, the red bank, the blue bank, and not that they're bad people, but at the end of the day, they need that money so then they can lend it out for mortgages. Let's talk about what are kind of your returns that you quote clients.
Yeah, so on our apartment fund, which is our flagship fund that's coming up on its 5th birthday next month. So that has always had a targeted return of 7 to 10% total return. So that is a combination of monthly cash flow as well as the share price going up over time. So we're very, we're comfortable with that. I want to under promise and over deliver, because I never want to have a conversation with a partner like you guys or an investor to say, ooh, we made a mistake and we got to cut the returns, or, ooh, we're going to close the fund and you can't get your money out. Like those kinds of things happen. And that's part of the risk of investing in private. So that's why it's important to, invest and partner with people that you trust and people that you think will take care of your money and do what they say they're going to do. So, for us, the proof is in the pudding. We've had, we're coming up on sort of 60 months of increasing and positive returns, never had a negative year. So I think last year we're tracking in sort of the 8 to 9% total return. So, it's not 20%, it's not 25%. As I said, you're not hitting a grand slam every time, but it's steady. It's just continued to increase over time. If you don't need monthly distributions, if you don't need that monthly cash flow, you can reinvest and get a 2% discount. So you get, free shares every month, as it were. So that helps with compounding. So it's a great way to, to just kind of shield a portion, as I said, shield a portion of your portfolio and let it grow, and you don't have to worry about it. Our second fund, slightly riskier assets. It's not just single family. Pardon me. It's not just multifamily. It is essential commercial real estate. So, it is, we don't have any office or retail in the portfolio. So we're protected that way, but it's income producing assets that aren't multifamily, as well as it does real estate lending. So large scale commercial lending, as well as real estate development. So slightly higher risk, but it's a one-stop shop because you get access to three different real estate classes under one roof. The nice thing is you don't have to also worry about, well, when one of the Equiton mortgages in this balance fund, which is our second fund, in the balance fund, if a mortgage matures, what do I do with the money? Well, we take care of that for you. You don't have to go and redeploy the money. We'll go and redeploy the money. Same thing with a development. When we have a development that completes, if you want to take the money, you can take the money, but we can then reinvest it into another development. So that's got a higher targeted return of about 8 to 12%. And so I think last year I think we hit about 11% in that fund.
Well, I mean, we all know who won the race, right? The tortoise or the hare. So I love
That's right.
the slow and steady. It's what we believe here in REC Canada. Yeah, with income properties, which are totally different than what we're talking about today. Yeah, you're going to see your 28, 29, 30%. But Simos and I talk about this all the time with our clients. Like, even if it was just 8%. Compounding year over year over year, we'll take that. The 25 and the 28 is like a massive bonus, and so love that you're also ultra conservative.
I want to remind Jazzy, when we look at the Toronto market and we talk about it doubling in value every 10 years, that return is a compounding 8 to 10% return. So when we're talking get rich slow, we're not talking about waiting a century. We're just talking, it's not a get-rich-quick scheme. Everybody has to realize that real estate, as to quote Clifford, God's not making any more land. Mm-hmm. In the GTA, we have a massive body of water, whether you're north of it, south of it, depending where you are in that golden horseshoe. Regardless, we have a big body of water. Typically, all big cities are sitting beside a big body of water. New York, Los Angeles, Chicago is on a Great Lake. All of these centers are typically on the water. So one side of them build on. On the other side of the GTA, we have the green belt, we have the highway structures, we have all these restrictions that limit the supply. So as we go through and we try to get through the red tape and through the development process, companies and corporations, just like Cliff and Equiton, just like other partners that we have in that space, look carefully day and night to pick the best assets, the best value-add assets, the best performing assets, underperforming assets that they can easily turn over in order to be able to centralize, pool, and use the power of many to make the common goal of winning in real estate true for as many investors, including themselves, as possible. I think that kind of really puts the nail in the coffin as to what we're trying to do with these funds. Cliff?
Yeah, no, you know what, and I listened earlier on to what you guys were saying about, the GTA being on sale. And, one of the things that we've had to kind of clarify or myth bust, if you will, for some of our partners is, oh my God, rents are going down in Toronto. Well, yes, rents have been going down in Toronto. There's a little bit more competition depending on what pocket of Toronto you're in. But turnover rent, so for those that aren't familiar, which I'm sure everybody is, but turnover rent is when an existing tenant leaves and a new tenant comes in. As a landlord and as an apartment owner, I can now charge market rent. I don't have to continue with the previous rental amount that was in place. So turnover rent. So, okay, Toronto's not going up by 25, 30, 40% turnover rent, but it's still going up by 8, 10, 12, 15%. So it's still increasing. You're still, as a landlord and as an investor in our fund, you're still making more money. You're not making as much as you would have pre-COVID, but as you said, there's a sale on right now. And, once everybody gets the vaccine, once everybody comes back, people are going to rush back to the GTA because that's where the jobs are. That's where, the entertainment district is. That's where people have their life. They're going to want to come back, and those sales are going to be gone because they're going to be gobbled up by the really astute, either, tenants or investors who are going to grab stuff now while there's a sale. We saw that in 2008. People were panicking, but those that were well capitalized and had money to deploy, there were bargains to be had. Just like in March, if when the stock market crashed, if you stayed put and you continued to buy more Tesla or more Amazon or more Peloton or whatever it was, you will have seen an exponential rise through 2020. So it's all part and parcel of the same machine, whether it be single family or multifamily, like what we're involved in real estate.
A lot of questions coming in the comments. I'm trying to just kind of keep an eye on those. We'll get to a couple of the questions just so we can be respectful to Clifford's time. But if anyone wants to be connected to the Equiton team, we make it really, really easy. It's why we have Clifford here, because we make sure that he provides the white glove service when you're coming from the REC family. Shoot a quick email to info@reccanada.com, and you can just put the subject line introduction to Equiton, and our boy Tyler Ty Walburn, our air traffic controller, will make that all happen.